All right, everyone. Welcome everyone to the next session of the AngelNV Entrepreneurs Bootcamp. So today we have a really good session with two speakers, and I'll introduce our speakers here in a moment. One, of course, you see in the room. The other is going to be tuning in from Reno in our northern ecosphere. This session is going to be just a little bit longer because we do have two speakers. Nonetheless, we will be making these resources available, the decks, the recordings. Those will all be available later as well. But again, I want to welcome you all to this next session of the AngelNV Entrepreneur Bootcamp. So for those of you that are new to this bootcamp and what this is all about, I do think that we should probably go through a little bit about what this process looks like and the timeline for this. So the entire concept of AngelNV is a double-sided bootcamp where we can take a lot of entrepreneurs that have a venture, or maybe they're thinking about starting a venture, and bring them through a series of coursework about a little bit about Startup 101 and a lot about raising capital 101, with a special emphasis on early stage investors and angel investors. And we run these companies through the course of this bootcamp, 13 sessions over 15 weeks, and we teach a lot of things from pitch decks 101, financials, storytelling for entrepreneur, amongst other courses. The entire idea is to give founders the knowledge they need to start raising capital, or consider raising capital, or give them the information they need to maybe realize, you know what, maybe my venture is a little early. Maybe I have things to work on. And now I have a little bit more resources and knowledge about where I'm going to go for those resources, what I need to address in my startup before I really hit the road and start raising capital and scaling this venture. Now, at the end of this, we also have the AngelNV Entrepreneur Bootcamp for the investors and the AngelNV Investor Conference. The entire idea about this is to help develop the investment and startup ecosystem here in Nevada, where we take dozens of accredited investors who are interested in investing in startups. We train them. We bring them. We show them how to conduct due diligence, how to engage with founders and find deals. And this all meets here in April, where companies among us, some of you that are attending online and in person, can apply to pitch to this angel group for an opportunity to win an investment of $400,000 minimum. So this year, we're really excited about this. And I want to talk a little bit about why we're able to invest this $400,000 in the winning startup, is because of the support from the Governor's Office of Economic Development, the state of Nevada, and the federal government through the SSBCI program, or State Small Business Credit Initiative. What this entails is that the state of Nevada will now make matched investments alongside Startup NV. So if we invest $200,000 into a startup, the state of Nevada will match that investment and the same terms that we do. So this effectively doubles the capital capacity of the programming and the investment funds that Startup NV and our associate funds run. So this is very exciting. It's great that we can bring this to Nevada-based startups, and we're looking forward to seeing your applications later in the year for an opportunity to pitch in front of this angel investor group. Now, without much further ado, I'm going to go ahead and introduce our speakers today. So today we're going to have, I said, a double session. We're going to be talking about financials and legal for startups. And we have two experts in this area. So first, we will actually have Alex Rochegude will be going first, followed by JD Peters. I'll introduce them both now, and then we'll have JD tune in a little bit here. But Alex is an award-winning entrepreneur. He's had two successful exits, and he is also a former partner at KPMG, which is a consulting firm, mostly in the financial services for larger companies, for startups. So Alex not only has the expertise on the startup and entrepreneurship end, but also the expertise on the finance and the financials end. After 10 years of working in corporate finance, Alex founded 4 technology companies in Silicon Valley and Europe to disrupt banks. And he's now focusing on the next iteration, his next part of the journey in healthcare. And Alex moved to Las Vegas not too long ago, just last year, from the Bay Area, where he lived for several years. And he's agreed to speak to our founders a number of times to bring his expertise to our ecosystem. So we'll hear it for Alex. And I will quickly introduce JD Peters, our other speaker coming in from Reno up north. JD is an investor, entrepreneur, and venture attorney. He recently joined Craig Macy Macy Partners Law, which is a boutique firm servicing startups in Nevada, Texas, California, and Washington. JD graduated from Vanderbilt and earned his JD from the University of Austin, Texas, Austin, and has been really involved in this ecosystem, particularly up north, in bringing venture expertise and the legal expertise related to venture and the startups ends as well. So we'll also give it up for JD, who's tuning in online. Next week, we really would like you guys to join us because we got a couple of great speakers coming up. Next week, we will have, as part of the Global Entrepreneurship Week, that is a global initiative kind of celebrating entrepreneurships and startups around the world. We're going to have Dan Steele, who is a investor, a successful entrepreneur, address Pitch Decks 101 and how to create compelling pitches for investors. And Faye Almashon, who's a venture partner entrepreneur, who is going to dive into go-to-market strategy. How do you bring your service or your product to market and reach your customers? And then down the line after that, 1 week, CJ Cornell is going to talk about raising capital, the intro to raising capital, kind of bringing this all to bear from the financial end, pitch decks, go-to-market, et cetera. We are really happy to be sponsored by Gust. Gust is one of the premier platforms for small startups to get their documents aligned, get their deal room ready for investors, and submit applications to various angel and investor groups. So we're happy to be sponsored and partnered with them. Give us a follow, give a share. You guys absolutely should be following us to figure out what's going on in this ecosystem, not just with Startup NV and Angel NV, but amongst the other organizations in this ecosystem. So please join, share, and get engaged in your ecosystem, both online and in person. Lastly, tomorrow, we're excited to have the Sip and Learn tomorrow and the Lunch and Learn in Reno. In Las Vegas, we're going to have Lisa Song Sutton, Feminine Powerful. Lisa's a venture capitalist, investor, a successful entrepreneur. So she's going to be speaking right here in this room in Las Vegas tomorrow at 5:30. Then up north, we will have the Lunch and Learn, Protecting Your Intellectual Property, with a focus for founders and startups by Craig Macy, who is a partner of JD's, who we'll hear from later. That'll be at noon at the Innovation Center. So those that are tuning in online or that are in Reno, please make your way to the Innovation Center tomorrow for a lunch and learn. And please, we've had a couple of issues with this. Please silence your cell phones for those in the room. It does still get picked up by the microphones we have. We want to make sure that everyone in here is able to enjoy not have any interruptions. And without further ado, I'm going to actually toss this over to Alex. Alex, if you want to go ahead and share your slides.
Thank you, Logan. Thanks a lot for being there. I'm very excited to be here to talk about the most exciting part of for an entrepreneurship journey, which is financials and legal. These are basically chores for an entrepreneur. You want to focus on the product, you want to focus on marketing, but actually financials is key to the survival of your company and the potential success of your company. I'll go very quickly on my background because Logan did an amazing job, better than I would have done. So, but basically I was a partner at KPMG, I was a director at PwC, but I have also founded a few startup companies, 2 successful exits, also a small investment fund, Aliro Ventures, with some success, some failures also on some investment. That's part of life. So I've seen kind of both sides, on the investment side, on the entrepreneurial side. And something I learned, and I like to start with that quote, is never take your eyes off the cash flow because it's the lifeblood of your business. If you run out of cash, your company is doomed. That seems obvious, but you always have to keep that in mind. It's not about profits. It's not about traction. At some point, it's all about cash. What is the cash you have on your bank account? And you can see in the media currently what's going on with different companies, successful companies, cryptocurrencies exchange. When they run out of cash, that's just over. So let's start. We start with the cap table, directly or not directly linked to the financials, but cap tables are very important. So the concept is that that's a spreadsheet, a table that shows the equity capitalization for your company now and potentially in the future. Why? Because it includes not only the shares that have been issued, but also all the shares that will be issued in the future. That includes options, that includes convertible notes, SAFE, and everything. You also want to pay attention to the employee versus investor ownership by stage. You don't want to be too diluted. You don't want to keep too much for you, because otherwise you won't be able to raise. So that's something you have to keep in mind. To do that, there are basically two ways. The first way, I would say the old school way, and I've done that for years and years, that was basically using Excel or similar solution, where you have the list of your investors, employees, yourself, the type of shares, type of options, the pool. That is a very good solution, but requires a lot of work. Not at the very beginning, but very quickly when you start having complex investment vehicles or convertible notes or SAFE options, you have to keep that updated. There are some other tools that exist today, such as CapTable, Carta, CapBase. You have to pay for it. And it starts, let's say, around $50 a month. The advantage of it is that they take care of all the complexity. And that's why for my latest venture, I decided to use, so in that case, it was Carta. They have 1 year free, but you have solutions such as CapBase, CapTable. They act as basically a broker dealer. So they issue the shares for you, they maintain the options, they execute the options, they execute the SAFE when you need them. If you have any questions, feel free just to ask if you're in the attendance, or just in the chat, feel free to. Regarding the accounting part, we are not accountants. I mean, usually. Usually we're entrepreneurs, we come from different backgrounds, but the accounting is obviously crucial. It will be a requirement for your investors, of course, but that's also important for you to help in. So it will help evaluating the performance of your business. So keeping records of your transactions, record of your progress is important for that. The issue with accounting is that can be very complicated, and you don't want to you don't want to mess up with tax. You don't want to mess up with salaries. Sales tax, if you ship nationwide or internationally, every state, every country has different rules. If you try to do it all by yourself, unless you have some expertise in it, you most probably make an error. If you make an error, it can cost you a lot, and a lot not only because the IRS will come to you, but also the investors will see that you cannot do it properly. So how to deal with that? Of course, you can get an accountant. The problem with an accountant is that, especially for an early stage company, it costs a lot of money, and it can cost thousands of dollars. And you'd better use that money to get some traction, to get some revenues. So there are some amazing tools, not to replace an accountant, but the question is, do you really need an accountant at the beginning? Actually, especially at the very beginning, you might just get a bookkeeper or a bookkeeping solution. Bookkeeping is basically following all the transactions, taking care of the payroll for you, of the tax for you, and everything. And for that, you have solutions. I don't get a cut on the fee, so I'm just not promoting specific solutions, just talking about the solutions I know, but there are plenty of other ones that are certainly as good. But you have Gusto, Wave App, QuickBooks that you can use. They will cost you starting at $50 a month. But trust me, that's really worth it, because the time you would spend taking care of the payroll, going on all the state websites to pay your tax and everything, you would waste just, let's say, hours, if not days. You probably don't want to waste your time on that. So my best advice as an entrepreneur is really try to use that kind of tool. The concept is the same as the CapTable. Sorry, just finishing. And so the concept is the same as CapTable. Try to outsource, if you can, things that are not core to your business, but very important. Yeah, sorry, you had a question?
Yes. Hi, Alex. We have a question from Nick. For early stage companies, how important is CapTable and DEX for raising capital, especially if it's an equal split between co-founders? Is issuing shares imperative? How do you decide on how many shares for early stage startup?
Before you raise any money, honestly, I would just keep it in an Excel file. Don't spend $50 just to, if it's between the 2, 3, 4 of you. I mean, that just doesn't make sense. So you can do it on an Excel file. Once you start having external investors, you have to be very careful because there is a lot of regulation around about how you can issue the shares, how you can make the follow-up. So I would strongly recommend, as soon as you have one investor, to get that kind of professional tools, such as Carta, Capbase, or Captable. Regarding the split between the founders, honestly, there's no one answer. And it really depends on each company, what everyone brings to the company. It doesn't have to be 25, 25, 25, 25. It really depends on the experience, on the company, on what they bring basically to the company. So for the accounting, once again, and I guess that JD afterwards, I don't know what you will talk about, but same for legal. I mean, try to rely on experts for those very sensitive topics. As an entrepreneur, you're supposed to be in charge of the marketing, product, sales, everything. When it comes to regulatory, legal stuff, try to be very careful with that because that can kill your company. Financial plan. So we're coming to the part I like because that's the part that is really important for an entrepreneur. The financial plan to me, in all my ventures before, and actually even when I was partner at KPMG, this is always the first thing I looked at. I'm someone who loves numbers, and the financial plan is something that will, of course, define the business forecast, revenues, expenses, but that's something that helps you have a clear view on the budget, but also, and I would say as an investor, to identify the potential of growth, to identify the resources that are needed, the hiring plan, the investments that are required, and also helps you know where your business stands towards your objectives. So the financial plan is not just a one-shot to go to investors. It's something that will be updated all along. This is something you will look at every month when you look at your KPIs, and you will compare it to what you initially planned. And so you have to update your financial plan accordingly based, if you plan to have 1,000 new users and you have only 500, there might be a problem. You might want to review your ambitions, your numbers, or just your marketing strategy.
Hi, Alex. We have another question from Paul. Have you heard of Party Round, a platform that offers a data room plus pipeline for investments that issues your subscription agreements or safe notes? It's essentially an all-in-one capital raising platform.
Yeah, there are a number of platforms that exist. Personally, at Phoenix, my current company, we have used Carta, which enables also to raise money directly. There's not one good solution. I mean, there are plenty of good solutions, and to raise money, it can be useful to use that kind of stuff because you get into standard terms. When you go to 3 different investors, most probably, if those are VC investors, you'll have 3 different term sheets and different terms across any of them. Maybe the same valuation, but the terms might be slightly different. So you want to keep track of that. So using that kind of platform can be really good.
Could you repeat the company that you use?
The one I use currently is Carta. Carta manages our cap table and is issuing the shares for us. They also enable to, when you have some investors that are interested, you just enter their email address and you define the terms, and they take care of the payment. They tell you when the payment is done, and then they issue the shares directly. So Carta, C-A-R-T-A. There are plenty of other solutions that are as good. That's the one I use, but there are plenty of other solutions that are really good too. Once again, when it's not your core business, when it's not about traction, about growing your company, try to outsource as much as you can. It costs money, but very often it's worth it. So if you can afford it, it can be a good solution. So back to the financial plan. There's the old school way. That's my way, still Excel, you know. Getting old, so still using Excel. Excel is really good to define in your financial plan, what do you want to see? As an investor, what I wanted to see was first, what are the assumptions? Because of course, I will look at the numbers in 1 year, 2 years, 3 years, But I first want to look at the assumptions. Why? Because sometimes the assumptions are so high that the numbers at the end do not make sense. I want to see if it's realistic. I mean, I want the entrepreneurs to make me dream, but I don't want it to be an utopia. I want it to be potentially realistic if it works. So of course, I want to invest in a potential billion-dollar company, but I want to make sure that it's feasible. If you tell me, if you come with a business saying, okay, I will sell, I don't know, vintage socks. What an idea. Why not? Is it credible? What's the size of the market? And what are your assumptions? If you come and tell me, yeah, I plan to invest $300 in marketing on Facebook per month, and I think I will have 10,000 users, buyers per month, I'll probably be kind of skeptical until I see it happen. So you want to define what are your assumptions in terms of growth, in terms of revenues, in terms of pricing. I want to see also what are the expenses. Very often, marketing, communication expenses are way under what is needed. People think that just putting a few hundred or a few $1,000s on Facebook will bring you tens of thousands of buyers. Not saying it cannot happen, but most of the time, the marketing budget, the communication budget is way higher than what was planned. So the financial plan is something that enables investors, but also the entrepreneurs to look at what is realistic, does it make sense? If you tell me you have 1 million active users and you have one person for customer support, I might be skeptical too. So I want to see how many people you plan to hire to support your growth, how much you want to pay them also, because I want to you want to make sure you have the best people. So you can do it the old way with Excel or other solutions. You can do it the new way. You have solutions such as Pride that will got acquired by Brex or Finmark. There are some other solutions too, once again. Those are just some examples, not recommendations. And the screenshots here are from Finmark. Basically, you enter all your information and they just generate all the KPIs, all the dashboards, everything that you need. Once again, I don't know if $50 a month is kind of a standard, but once again, it starts at $50 per month. You can do all that on Excel. The risk with Excel is that you'll have a lot of formulas. If you mess up with the formula, and on Excel, trust me, that happens a lot. You just delete something or you forget to update the formula somewhere, then your financial plan might be wrong. So when you do it on Excel, you have to review it again and again and again. The risk of errors with a solution such as Pride or Finmark is way less, and it's way easier to update it also and to have interesting information, and we'll talk about the KPIs afterwards. So I want to emphasize once again that the financial plan is one of the key documents any investor will ask, every investor will ask, but also something that should be used, honestly, at least on a weekly basis by every entrepreneur, every CEO to follow up on their ambitions. So let's talk about the KPIs. So KPIs, when you talk about finance, you talk about financial statement, equity, EBITDA, many other stuff. Keep in mind, once again, I'm talking about early stage companies. I'm not talking about unicorns that can have a CFO, that can have an accounting or a financial team. I'm talking about entrepreneurs who need to have some KPIs. And those KPIs, those are so the KPIs are key performance indicators. So they have to be oh, that's a complicated one. Quantifiable. Next time I would change the slide. They have to be quantifiable, which means that you have to be able to measure them. So we're not talking about branding, feelings, and that kind of stuff. We talk about basically numbers. And you will use them not only to measure the progress, but you will use it also for strategic decision making. And we'll go over what I consider being the key ones. First one, so the runway, burn rate, revenue, MRR, RPA, revenue churn, lifetime value, CAC, COGS, gross margin. That sounds awful when we see that. Yeah, sorry. Yeah. So the 10 indicators here is basically what every investor would expect you to know by heart. So when you will talk to an investor, I mean, you have some eccentric investors, but most investors basically will ask you about some of the 10, maybe not all of them, but some of them. And they expect you to answer right away. They will not ask you, oh, do you know what will be in May 2025, the payroll for the marketing team? They don't expect you to know that by heart. But those numbers, they expect you to know it. And they expect you to know it because that is important, not only for them, but also for you. So let's go one by one. Does that answer? Oh, yes, sir. Regarding the financial plan, asking what should be the forecast, if it's 6 months, a year, 2 years. So it really depends on investors. Some investors will ask you for a 5 years forecast. I mean, I respect that. That's fine. To me, especially when you're in early stage startups, when you did not start, 2, maybe 3 years should be the max, because otherwise it just, I mean, even 2 years, if you stick to your financial plan over 2 years before launching a product, I mean, wow, I've never seen that before. I just want to see that as an investor, that there is some potential progress. I'm not asking you to see that you'll do $100 billion in 10 years. I mean, that's just guessing, inventing numbers. It has to be quite accurate. I mean, as accurate as you can over 18 months. So they will ask you to be quite accurate over 18 months. They know it's not 100% accurate, but that is feasible over 18 months. After 18 months, when I was an investor, everything after 2 years, 2 years and a half, I didn't even look at the numbers, because you just put a percentage of growth, and I mean, at some point that just does not make sense. So for the KPIs, so those are some very important numbers, and you can find it on the internet also, but basically those are always more or less those KPIs. First one is the runway. So what is the runway? Runway is how many months your startup has before it runs out of cash. So that's basically how many months you can survive before the company crash. And I started saying that cash is king, cash is key. And this is because this is what will kill your company. If you cannot pay for your AWS servers, if you cannot pay for your emails or whatever, company is just dead, period. How many months can you go? And usually when you raise some money, they will expect you to have a runway after you raise around 18 months, even more in the current economic environment. So 18 months, so make sure that you cut costs enough, enough that you get enough revenues to survive for 18 months. Then you have the burn rate. So the burn rate is just how much cash you lose every month. Once again, we go back to cash. We're not talking about profits. We're talking about the cash on your bank account. You save $100,000, you have expenses of $200,000, that's $100,000 burn rate per month. And that's how you calculate by your runway also. You look at the money, the cash you have in your bank account, you look at how much you burn. Nothing fancy, but those are some things that you have to know by heart. And that's why investors want to know about. Revenues, well, total amount of money your company gets for products, services, everything, obviously. MR, so monthly recurring revenue. So that's more for usually subscription-based companies, SaaS companies. Investors love MR. Many of them don't care much about revenues, because revenues can be a one-shot. You can start selling your vintage socks, for example, but if you don't have a subscription, you can just have a peak, and then 2 months later, nothing. So how can you have a forecast, a financial forecast? Investors love that. Well, CEOs, CFOs love that too, because it enables you to have a pretty good forecast about if you have 100 subscribers, you're most likely to keep more or less the same. I mean, can be 90, can be 110, but you have basically, you have a base that you can count on. So those are the revenues those are basically the recurring revenues, the revenues you'll get each month from a subscription most of the time. ARPA, the average revenue per account. So this is the average amount of revenue that you make from each paid account you have. So be careful, we're talking about accounts, we're not talking about users. And that can be very different when we talk about B2B, for example. Let's say I have a customer that is Startup Nevada. That's one account. Startup Nevada is the one that is paying me, that's one account. But they have 10, 20, 30 people, I don't know, whatever. Let's say 20 people. Those are 20 users, but it's still one account. The reason why usually investors prefer to look at the number of accounts in terms of the number of users, especially in the B2B world, is that if Startup Nevada is my large, if I have 25 users, but Startup Nevada is 20 of them, if I lose Startup Nevada, I'm dead. I mean, you lose most of your revenues. So that's why the startup per account, the revenue per account can be so important compared to revenue per user. That's more on the B2B side. On the B2C, they will ask you for revenue per users, which is usually revenue per account. And that's 1-1. Then you have the revenue churn, so the MRR churn. You have those 100 users, and from those 100 users, you make $1,000 revenues, monthly recurring revenues, so $10 per user. We hope you'll get some new users, but you will also lose some users, or maybe some users will go from the $10 subscription to the $5 subscription. So you will lose money on those people, and this is the MRR churn. And you want to monitor that for 2 reasons. First, because, well, you make less profits or you make less revenues, but second, it might also indicate that people are not happy with your product or not 100% happy. So they took that $10 subscription and they decided to go to the $5 subscription. Or let's say $8 because it's trendy right now. So they go to the $8 subscription. So you want to have the churn that is as little as possible because you want to increase your customer base, but you want also to sell more and more to your existing users. Customer lifetime value. Acquiring users, acquiring customers is complicated and costs a lot of money. The question is, once you have acquired them, how much will you get from them over their lifetime as a consumer, a customer of yours? So my customer that have $10 per month, let's say it costs me $50 to get him. Well, if after 4 months, in average, people leave, I get my $40, but I paid $50 to get it. That's not really good. And that's why, for example, credit card companies, they will give you $300 per cash back or whatever stuff, because they know that over time, your lifetime value will be way more than that. I mean, the financial industry a few years ago in banks, usually customer acquisition was around $500. So it cost them $500 to acquire a customer. So the lifetime value had to be higher than $100, and ideally much higher. Which leads us to the customer acquisition cost. And this is also very important. And I was talking earlier about marketing costs that are very often underestimated. It has a huge impact because your customer acquisition, how much does it cost you to get a customer? And of course, you have some viral growth that happens, but most of the time you have to do some marketing or to have some sales guys. And usually the sales guy will be the CEO, but in early stage companies. But you will have to spend some time of yours, and time is money. So that's your time that you spend on it. How much does it cost for you to get a customer? And of course, at first, it costs a lot to get your first customers because you spend a crazy amount of time. But you expect that over time, after a year, your customer acquisition cost will be acceptable. So if you use an influencer, how do you assess the cost of it? First of all, you will take into account how much it costs you to get that influencer. Maybe it's a friend of yours that will do it for free. Amazing. That's great. Most influencers get paid. So when they talk about the product, usually they get paid for it. So you have to take that cost into account. If that's a friend of yours or someone that loves your product and decides to talk about it for free, or you manage to convince Oprah to talk about it, okay, that's free marketing. Excellent. That's free and that's cool. Okay, that's fine. But that's a one-shot, one-time stuff. How do you manage over time? Do you expect that influencer as your only communication channel? Or do you expect to have more than that? Let's say you have an influencer with 100,000 or 1 million people following them. So kind of a big influencer already. And you get 10,000 users. Amazing. How do you get the next 100,000? As an investor, that's what I will ask you. Okay, you got 10,000 through your friends, through an influencer. Excellent. How do you go from 10,000 to 100,000? 100,000 to 1 million? How do you manage that? And then you have customer cost. So the cost of goods sold, that's also very important. I mean, all the stuff could seem obvious, and that's why you have to know them. But let's say I have my vintage socks once again. Next time I'll try to think about a better example, but let's stick to that example about my vintage socks. I sell them for $10. How much does it cost me? How much does it cost me to buy the socks, to ship them, and everything? And then that's how I calculate my margin afterwards, how I can make profit. If you have a software, that's your AWS servers, that's your whatever you need to run, to produce the product. You have to know it by heart. I mean, at Phoenix, we have some DNA kits. So we're in the genetic area. We look at your DNA. So how much does it cost us to analyze your DNA? The kit, the shipping, the analysis itself, the genetic counseling. We have all the details for investors of how much every step costs us. So let's say it costs us $300 and we'll sell the solution for $500. That means that our gross margin is 40%, which is good. Does not include the marketing, does not include my salary, which I don't have, but does not include any of that. It includes just the cost of the product and how much you sell it. Yeah, we have a question here. So the customer acquisition cost is something, all that is something that you will have basically from your financial plan. Before you launch the solution, you don't have a strong numbers, but you think that if you spend $10,000, you will get, let's say, 100 users. It means that your acquisition cost is $100. But then once you launch your solution, you will spend your $10,000. And let's say that you have only 50 customers, new customers. Well, it means that your customer acquisition cost is $200. But over time, you expect that with the word to mouth and everything, that it will decrease. So you look at your marketing expenses, you look at your sales team potentially, and you look at the number of new customers you get. Sorry, the question was, how do you calculate the customer acquisition cost? So really look at your marketing, sales budget, how much you spend on marketing, on sales, and how many new customers you get, or how many new customers you hope to get. So how do you calculate the average revenue per account, not per user? Well, if we have, to stick to my example, if my customer is Startup Nevada, if my client is Startup Nevada and they have 20 employees and those 20 employees are users of my solution, I have one account, which is Startup Nevada, and I have 20 employees. Usually in your system, you will know, basically that's who's paying for it. The account is the one who's paying for it. For Startup Nevada, it will be the company that will pay for it. It will not be the employees that will pay for it. That's the case, for example, for when you get healthcare benefits. The company will pay for it, and you might not pay for it. So the company is my client, doesn't mean that they are my user. You can have two numbers. You can have the average revenue per account only for companies, for corporates, or distributors, and you can have one that is per user, the average revenue per user for the B2C side. So if you do B2B and B2C, you can provide two different numbers saying, okay, in my B2B activity, This is the average revenue per account. For my B2C activity, this is the average revenue per user. Once again, try to keep it simple as much as you can. Investors ask very often simple questions. They want simple answers. Yes, sir. So what's the for the customer lifetime value? What's the time frame? It really depends on your business. Imagine your Facebook. You expect the lifetime value of your customer to be over, let's say, 10 years, or maybe 20 years. If you're selling sneakers for kids, lifetime value would be lower. I mean, maybe the parents would buy it, but the kids will stop buying it after some time. So the lifetime value for let's say, Lego, for example, Lego toys, I mean, you don't expect people being 20, 30, 40 years old to buy Legos. Well, some might, but that's not the usual one. So the lifetime value really depends on your business. Yeah, so the gross margin, total revenue left after factor. So the financial plan is, to me, the very first step. If you have a strong financial plan, you'll get the KPIs easily. You will get those KPIs easily because you will update your financial plan and you will get those KPIs very, very easily. And then you have the financials for investors. Of course, they want all the KPIs, they want the financial plan. But especially, and I guess they will talk about it in the pitch deck part, but there are a few numbers that you want to show them. You know, a pitch deck is kind of a teaser. It's like like for a movie, you want them to know more, and you want them to ask you a question about your KPIs, and then they will ask you to send the financial plan so they can dig deeper. So the financial for investors, you want to provide them the key information they need to assess the company. They want to know, what does it take for the company to be profitable? They want to know what would be the return on investment. I mean, if they invest, maybe it's because they like you, but most probably they want to have a good return on investment. And they want to know how you will spend their money, because that's their money. Imagine you have a friend you meet in the street, he asks you for some money. What's the first question? He asks you for $1,000. What's your first question? What for? Right? Investors are the same. Ask you for $1 million. Okay, what for? How will you use it? Does it make sense? So ideally, you want to show them some traction. I'm talking about traction. I'm not talking about revenues. I'm talking about traction. So everything that is kind of positive that shows that people are interested in it. If your company has revenues, amazing, great. Show them the revenues. Might be also just some downloads. In that example, it's the number of templates that were downloaded. Or you have an app and you have 10,000 people who downloaded your app. They're not paying for it. So you don't want, I mean, you cannot really talk about revenues, but you see that there's an interest from people. Can be also some requests and everything. Can be a waiting list sometimes. Maybe you have not launched your solution yet, but you have some people who are on a waiting list who say, I'm interested, I'd like to know more, I'd like to try this solution. So you want to show them your traction. Ideally revenues, but can be something else. And then you want to show them projected revenues. An investor in a startup environment, they will want to have a good return on their investment, not just double their investment, because they will make 10 investments and they will fail on 8 of them. So they will want to make times 10, 20, 50, 100, depending on investors. So you have to make them dream. If you tell them, I need $1 million now, and you can get back in 5 years, if everything works and we have an amazing growth, you can get back $2 million from it, they will pass, because that's always the best case scenario. The most probable scenario is that you will fail. So unfortunately, as an entrepreneur. So the point is that you have to provide them some revenues that can make them dream, but at the same time, that are with numbers and assumptions that are credible, because they will look at your financial plan. So make them dream that realistically. And then the use of funding. This is what I will use for the product. This is what I will use for sales and marketing. This is what I will use to hire the top-notch engineers, the top-notch sales guys, top-notch marketing people. So how do you use I raised $6 million. This is how I will use your money. And with that money, this is what I will get. I will go to 1,000 active users, paying users, 10,000 active users, or I will go to 4 million monthly recurring revenue. So you have to show them that kind of stuff. So do angel investors expect a higher ROI than this is? Yes. Because the earlier, the more risk you have. If you come up with an idea, oh, I want to make a flying car, what are the chances you will succeed to build it, to sell it, and to make money out of it? If you go to a VC investor, you already have a prototype. Look, let's go and take a ride. And you're in your flying car. So you know that the product might not be 100% down, but is already working. And you have a waiting list also. So the risk, well, but much, much lower at the very early stage because the risk is crazy. I mean, you just trust that we believe that that's a good idea and that that's a good team. And I believe this team can execute. I don't see a product yet or just very early stage prototype, but I think that this team can execute well. Key takeaways. Once again, cash is king. You must have cash on your bank account. Second, keep track of your KPIs because that will help you manage your company. And whatever you're in, I mean, I work with top executives from some of the largest banks in the world. I've been a startup with 2 or 3 people. Every single CEO is successful CEO is keeping track of the KPIs. You must know the numbers because that's how you manage a business. Keep it simple. When it's complicated, when it's about legal stuff, regulatory stuff, try to get an expert. Try to use a solution, a tool. Keep everything as simple as possible. It's complicated enough to run a company, to start a company. Don't get into other stuff that are not necessary. And that's the point of outsourcing also. That's, key performance indicators. Indicators, yeah. So those are all the stuff you measure. Sorry, I've been in that word for too long. So keep really, I mean, the 2 ones are the 2 most important advices to me. Keep track of your cash, keep some cash on your bank account, and keep track of your KPIs to see what's wrong, what's going well, what's going wrong. And
Alex, thank you so much. We appreciate it. And we'll take any questions from the room.
So the question was on the 18 months of runway that was needed. So 18 months is what you should get after you raise money. So right after you raise money, you should have enough cash for 18 months. Now, before, obviously, I mean, it's, I would say, paycheck to pay by paycheck.
Yeah.
So your first question online, is Carta the best platform you've used to date?
That's probably one of the best platforms. I think they are the leader on the market. That's also the most expensive. Carta is used not only by early stage startups, they are used by a lot of much larger companies also. So I don't know if it's the best. It's a very good one. That's probably the most expensive one also. So they have that. I used it because they have that program, which is Carta for startup or whatever the name, but basically something for startups where it's free for 12 months. And afterwards, I think it's something like $1,000 per month. So it's kind of super expensive. If you take something like CapBase, it would be $600 per year, but there is no free period, trial period. So you have some pros and cons. Carta is really good. CapBase is really good.
There's a number of services out there. You should absolutely do some research on some of those companies and compare and contrast, and you'll find you'll find a match, or you'll switch platforms eventually.
It's always to say the best because it depends also on people preference. I use Carta because I used Carta in larger companies before, and because they had that free version for 1 year. CapBase is a great. I already talked to the founder a few months ago. It's a great solution to that. As a startup, you don't have much needs anyway. I mean, you're not looking for the very best solution that has the most features and so ever, because you probably use 5% of the platform anyway.
Paul is asking just for some clarification. He said, "Are you saying CapBase?"
CapBase.
CAP base.
Yeah, CAP base, BASE.
Lisa has a question. Can you explain more about outsource as you can? What are examples of outsourcing? What are the benefits?
Well, it's outsourcing. You probably don't want to outsource for your product development and that kind of stuff. Because that's your core business. You probably want to outsource your accounting, bookkeeping, legal stuff. And when I say outsourcing, can be to a lawyer, can be to an accountant, can be also using a tool. I mentioned Gusto, Wave Apps, Carta, CapBase. I mean, you can use some tools that are professionals. The needs of a startup are, once again, you want to keep it simple because the needs of a startup in terms of accounting are usually very simple. You'll always find some exceptions, but most of the time that's simple. You don't have much to manage. So you want to use you might want to use some solutions and outsource everything that comes with some complexity. So for the product development, you want to do it by yourself. Investors will want you to know everything about your product. When it comes to accounting, I don't think any investor or legal stuff, I don't think any investor will try to trick you into complicated questions about legal stuff in whatever state. I mean, they're not expecting you to know about it if it's not your core business.
Alex, I think that's all the time we have for the questions on this. Thank you so much for coming in and tuning in. Everyone, we will be, and I'll announce this again later for those that might come in a little bit late, we will be sending Alex's slide and a recording of this session to you all.
Feel free to reach out to me if you have any additional questions.
Up next, we have JD Peters. He's going to talk about legal for startups. JD, the floor is yours.
All right. As Logan mentioned, my name is JD Peters. I'm an attorney here in Reno. A little background about myself. I mostly focus on high growth entrepreneurs and high growth companies. I started practicing law in 2014 in Austin, Texas, in the Austin office of a Silicon Valley-based law firm called Wilson Sonsini. And then later worked at a New York-based boutique, and pretty much that whole time focused on startups, everything from formation all the way through exit. I moved back to Reno in 2021, and early this year partnered with Craig Macy, who I believe you'll all be hearing from tomorrow. And we started a firm, Macy and Peters, and we're focused again on representing high growth companies. Nice boring slide here for everyone, just to say that everything that we're saying today and that I'm presenting on is general in nature and not legal advice. And this is not creating any attorney-client relationship. Here's a bit of a roadmap for what I want to talk about today. I want to talk a little about entity structuring. I want to talk about qualified small business stock. I want to talk about kind of employee equity. I want to talk about fundraising with convertible notes and safes, doing priced rounds, and talk a little bit about protecting IP ownership. So that's kind of where we're going. So the first thing I want to talk about is, what's your entity structure? What should you choose? You've come up with a business idea, maybe you have a partner, maybe you even have a product, and it's time to kind of create an entity, if you will. Most high growth startups are Delaware C Corps. And I'll get into the C Corp part here in a minute. But why Delaware, right? You always hear that. Everybody's a Delaware C Corp. And I think there's really two main reasons. The first reason is, I think, legitimate, and it's that Delaware has a pretty well-established corporate law regime. It's well understood by investors, by lawyers, by most. And they also have a very sophisticated judicial branch. And basically, you kind of get the outcomes you expect when you have a dispute or when you're doing business as a Delaware corporation. The second reason is less interesting, I would say, and it's mostly just because that's what everyone else does. And if you're a startup company and you're trying to raise money, often a box in a checklist for a VC or for an angel is, are they a Delaware Corp? And if the answer is no, at the very least, you're going to have to explain why. And at the very worst, on to the next one. And so that is just kind of the self-reinforcing situation where, part of the reason why so many startups are Delaware C Corps is because so many startups are Delaware C Corps. So not super interesting, but reality. Now, Nevada is becoming a more commonplace for companies to incorporate. There's actually some interesting differences between Nevada corporate law and Delaware corporate law. I think kind of the high level take is that Nevada corporate law tends to favor directors and officers in terms of protecting them over protecting shareholders. And so, for example, the fiduciary duty requirements for directors and officers of Nevada corporations are much more lenient than that of Delaware corporations. There's also this interesting provision in the Nevada statutes that requires a 2/3 vote of the outstanding shares to remove a director. And that's a pretty big difference from Delaware, because in Delaware, it's a 50% requirement, 50% plus one, a majority requirement to remove a director. And so, you know, I was recently working with a client who has a co-founder, and, you know, they're a Nevada Corp and they have a 60-40 split, right? And so you would think that the person with 60 kind of has the ability to control that entity, to control the direction of the company. But really, because they're both on the board of directors, there's really not an ability to completely impose your will, if you will, for the majority holder. So it's important to keep that in mind if you're creating a Nevada corporation, in terms of how you do your initial structuring, whether you have any sort of like buy-sell agreement, things like that. Just keep that 2/3 requirement in mind, because that is kind of an oddity. When it comes to why a corporation, I'll start with this. Why not an LLC, right? And LLCs are great for a lot of businesses. They're great for kind of traditional, you know, they're often called cash cow type businesses, where you create a product or you provide a service and you make money and you distribute that money out to the owners and everything's great. And the reason an LLC is good for that is because there's not two levels of taxation with an LLC. A corporation actually is taxed at the entity level, and then those distributions that are made to the stockholders, those stockholders have to pay, you know, regular taxes on those as well. So the question is like, okay, well, why a C Corp then if there's this second level of taxation? And I think there's really three reasons, two of which are closely related. And one kind of comes back to why Delaware, and it's because, you know, that's what investors want. But then the question is, okay, well, why do investors want C Corps? And the answer to that is qualified small business stock. And we'll get into QSBS here in a minute. But basically what QSBS provides is a huge tax windfall opportunity where you can sell your company for a substantial amount of money and not have to pay any taxes on it at all. And I think there's one additional really interesting reason, or at least compelling reason, to have a C Corp, and that's employee equity. Employee equity in an LLC is pretty complicated. It gets really into the weeds on partnership taxation and a lot of things that is just way too complicated for typical employees to be able to deal with. And so I think employee equity is kind of the third reason, in my opinion, on why to do a C Corp. So qualified small business stock. What is qualified small business stock? Well, qualified small business stock is a provision in the tax code that provides an opportunity for massive tax windfalls. Now, to have the opportunity to get this tax windfall, you have to be a C Corp. The other requirements for QSBS is that the stock has to be acquired directly from the issuer. So it needs to be an initial issuance you have to buy the stock from the company. You can't buy it from someone else. The idea is qualified small business stock, but small business here is, I would say, quite a relative term, because the test is a $50 million in asset test. It's important to keep in mind that this is as of the date of the issuances or immediately after. So one of the things that would be a bit silly if a startup went out there and on day one obviously it'd be great, but if you went out there and you raised $51 million on day one, it would probably make more sense to raise $49 million on day one, because you would lose this QSBS. Issuer conducts a qualified active business. This is, there's not a ton of guidance on this. It's negatively defined, but most software companies, most startups qualify for this. The issuer does not engage in a disqualifying redemption. You need to be a little bit careful if you're doing redemptions of founder stock to make sure you don't blow this. And the QSBS is held for more than 5 years. So those are the requirements. Well, what's so great about it? Well, what's so great about it is that there's a complete tax exclusion of the greater of $10 million or 10 times your adjusted basis. So here's an example. You start a company, you own 100% of it, you build the company, everything's going great. You hold the stock for 5 years, you sell the business to a buyer for $10 million. When that deal closes, not only have you had a great day, but it's an extra great day because you have QSBS that you've held for more than 5 years. You pay no federal income taxes at all. So it's pretty crazy. And the reason that investors like it is, obviously this is great, but they can actually get up to 10 times their basis. So if an investor comes in and invests $2 million or $3 million, they can actually get $20 or $30 million in return if they have that 5-year hold and the other requirements are met. So it's just a crazy situation where basically the tail wags the dog on, okay, well, this is why most of these companies are C Corps and why you hear, oh, you got to be a C Corp if you want to get VC investment. This is really why.
JD, we just have a question online. Would you like me? Nick is asking, what do you mean by 5-year hold?
So what I mean by 5-year hold is you have to purchase the stock and then held it for 5 years before you sell it. So if you're a founder, typically you would issue yourself some shares immediately upon founding the company, and you would need to not sell that stock for at least 5 years to be able to qualify for this exclusion. There is a little bit of nuance around, you can actually like roll it over into another company. So if you get bought and you roll over some of your stock into the buyer and you keep going, you can tack on your time frame. But generally speaking, what it means is you bought the stock and then more than 5 years later, that's when you sell it. So that's QSBS. And that's like, honestly, it's not something you'll necessarily hear or read about all the time, but it is really a borderline absurd tax windfall. So now let's talk a little bit about initial structuring, kind of what happens. Okay, you've decided you're going to be a C Corp. What do you do next? The first thing you do is you file your certificate of incorporation. In Nevada, it's called the Articles of Incorporation. This is basically the constitution of the company. It sets forth the rules in terms of how do you vote, how much stock is authorized, what's the par value of the stock, are there any specific rights of the shareholders included in there? All this kind of stuff goes in there, and the company can't do anything that violates its certificate of incorporation. So you file that. After you file that, there should be an initial board of directors that's compromised, and what they do is they do an initial board action that approves a bunch of different things. It approves the initial issuance of shares to the founders. It approves bylaws. If you're going to have a stock option plan, it'll create that. So it does a lot of different things. It's called the organizational board meeting, and it really kind of just sets the corporate governance and capitalization framework for your company. Now, one thing I want to emphasize here that sometimes gets kind of brushed over when folks are starting companies is that, especially if you have a corporation, you need to actually issue the shares to the founding team via stock purchase agreements. And there's lots of different, the clerk helps you do this. A lot of different things help you do this. Obviously, attorneys can help you do this. However you do it, you got to make sure that you have a stock purchase agreement, you have your board authorize the issuance of shares, and you get some paperwork that shows those shares have been issued. And what happens if you don't do this is it can lead to some pretty difficult issues down the road, because when you form the company has no value, right? It has no assets, it has no anything. So you're able to buy stock in that company for basically nothing. par value. As you build the company, as it accumulates assets, as your product gets better, as you get customers, things like that, the value of that company increases. And so if you haven't actually issued those shares, it's going to be a tricky problem, because the IRS is going to look and say, oh, well, hey, you just issued yourself shares in a company that's worth $1 million. And now all of a sudden you have a phantom income problem, or, you know, you're going to have to pay for that stock, or things like that. And there's not a real great solution to this problem other than, when you start a company, issue your shares immediately. Another important piece that goes along with that is, if there's more than one founder, it's critical that you have vesting on your stock. And what vesting is typically a repurchase right if one of the founders decides to leave the company. So what is a really horrible situation is, you have two founders, they start a company, 50-50, things are going great, no vesting. After 6 months, one of the founders decides, I'm out of here, I don't want to do this anymore. Well, if they don't have vesting on their shares, they're going to walk off with that 50%. And that's just going to be complete dead weight on your cap table. And it's going to make it almost impossible to raise money. It's going to just pretty much ruin the capitalization of your company. So vesting is critical. And when it comes to founders and most employees, the schedule that I see the most is a 4-year vesting with a 1-year cliff. I mentioned that one of the nice things about corporations is it kind of simplifies employee equity. And employee equity tends to be a great incentive for high growth companies. You know, often they're cash strapped, but what they can provide that others maybe cannot is, you know, that upside potential of owning equity. And so it's pretty simple. The board creates a stock option plan, an equity incentive plan, whatever the nomenclature is for the specific plan. And the board's actually able to grant equity to employees via specific securities law exemption 701. And they're able to say, hey, you know, employee number 5, you came on, we want to give you an option to purchase 50,000 shares. You know, hey, we need to hire a CTO, let's give them 5% of the company, things like that. And so there's the ability to make those transactions pretty easy. In terms of what the security is, it's almost always a stock option, at least after a certain point in the company's growth. And what a stock option is basically a right to purchase the equity at a set price. Again, these will have vesting on them too. Typically 4 years for employees. You can grant equity to advisors. That's often a 2-year vesting schedule. And what the stock option says is, hey, we're going to grant you this option with an exercise price equal to the fair market value of the stock today. And you don't have to exercise that option right now. So the employee has no out-of-pocket expenditure initially. They also have no taxable event initially. The option is granted, and as long as it's granted at the fair market value, then it had with an exercise price of the fair market value, then there's no taxable event. For employees, if they're able to get ISO treatment, which there's 2 main treatments for stock options, ISO and NSO. Employees are the only ones eligible for ISO treatment. ISO treatment has the advantage of, even after you exercise that stock option, there is a very good possibility there's no actual taxable event at that time. NSOs, that's not the case. NSOs, when you exercise your stock option, there is going to be a taxable event that is an amount that's based on the delta between the exercise price and the fair market value of the shares at the time of exercise, excuse me. So stock options are great. Employee equity for an LLC is pretty complicated, not really something I want to get into right now, but really kind of a headache. So that's another advantage of the C Corp. Another critical thing for especially founders that haven't necessarily been through it before, and just really early stage companies of all kind, is focusing on protecting the ownership of your company's IP. Tomorrow, I think Craig's going to be talking about kind of protecting your IP from others with trademarks and copyrights and things like that. What I'm talking about here is protecting the ownership of the company's IP. And it's critical that the company as an entity owns all the IP that it thinks it does. So, all the product development, all the branding, all the copyright and trademark, and all these important things, it's really important that it's actually owned by the company. And The way that you do that is through a variety of agreements. Founders will typically assign, assign is basically a fancy word for transfer. They'll transfer the IP for what they've done up to that time and going forward to the company when they buy their shares initially. For employees, it's critical that you have employment agreements. These are often called PIIAs, Proprietary Information and Invention Assignment Agreements. And what they have is a lot of different things in them, including confidentiality obligations and this assignment of works concept where if they're doing something for the company owns it. And it's super critical for all service providers, employees, independent contractors. If you're outsourcing development work, it's critical that you have an agreement in place that says everything that that outsourced developer is creating is actually owned by the company, so that a couple of years down the road, when you're trying to do a big VC deal and they're diligencing your IP ownership, there's not someone who's not involved in the company that actually owns the IP, because that can create a lot of trouble. So there is a bit of a magic word situation with this, hereby assigns. You can see there's been some court cases where agreements will say something like, I agree to assign, and the court has taken the position, which, you know, take it how you will, but this is what they said, that basically requires a future action. You're agreeing to assign something, but you haven't done it at that point. And so this hereby assigned language makes sure to protect the company, because it knows at that moment it owns the works in question. The final point here is, you know, as your company grows, especially if your customers are larger companies, Facebook, something like that, a lot of times they'll throw an agreement at you that is gnarly. It'll be 50 pages long. It'll be almost impossible to understand. It's really important to make sure that there's no unexpected IP transfers that are involved in that agreement. That's a critical piece. You don't want to accidentally be transferring IP to a customer, and certainly not to a competitor. The last couple slides here that I want to talk about are about raising money and kind of the instruments that are used. Early stage companies tend to use convertible instruments, whether it's a convertible note or a safe. The reason for that is there's a few reasons. One is they tend to be a lot more simple. They're pretty standardized documents that are easy to negotiate. Really, the only negotiated pieces tend to be what's the valuation cap, what's the discount, and I'm happy to, if there's questions about what that means. So basically, the valuation cap is the upper limit at which the investor's investment would at some point in the future convert into equity. So if it's a $5 million valuation cap, that's the highest price at which their note or safe will convert into equity. The discount is another way to go about it. And that basically says whatever the future round, the Series A, the Series Seed round, where we sell preferred stock, whatever the price per share is there, well, we're going to put a discount on that. And that is going to be the price that the earlier investor gets. So both of these are incentives for people to invest earlier rather than later, because they get a lower valuation with respect to their investment. The main difference between these two is the interest rate, which is all of a sudden interesting in terms of what that number is. It for the last many years has been basically a non-factor, a very low 2 or 3%. It's going to be interesting to see what the market accepts in terms of convertible notes these days. Maturity date's critical, though. The maturity date, Alex was just mentioning, runway, and you need to make sure that your maturity date kind of aligns with your runway and also with your capital raising strategy. So I tend to advise clients that you want this to be as long as possible. Kind of 18 months, I would say, is the shortest that makes any sense. 2 years is what I push for. And if you can get it, I would say try to get 36 months for a maturity date. Priced rounds are when you sell preferred equity to investors at a fixed price. And these are the things that you'll see in the financial news with respect to like a Series A financing, a Series B financing. They'll say, hey, company X closed a Series A financing at a $20 million valuation. That's a priced round. And price rounds tend to be far more complicated in terms of what gets negotiated. Obviously, valuation is always a critical piece in terms of negotiation. But there's other important ones in a priced round or even a convertible round. The main, I would say the biggest one other than valuation is board composition. So are you going to give an investor a seat on the board of directors? And the reason that's so critical is because board of directors is able to really guide the company in a much more hands-on way than the stockholders. So even if you have an investor, if they're not on the board, obviously you want their input, you want to keep them in the loop, but they don't have, a ton of say with respect to the actual ongoing operations and strategy of the company. The board of directors sets that. And so, when it comes to investors wanting board seats, there's a lot of strategy around that in terms of, okay, how much is it going to cost? How big of a board do we want? And how are we going to protect, how are the founders going to protect themselves in terms of making sure that they're not able, they can't get fired, things like that. So, I'm happy to answer questions on price round. Basically, that's when you issue preferred stock and things like convertible notes and safes, they convert at that time into equity of the company. That's really all I had for my presentation. So I'm happy to answer any questions that anyone has.
We wait for any questions online. Logan, do you have any questions in the room?
JD, the question was, he has a international partner, and he's wondering if he should probably outsource the legal contracting and negotiation with that partner for any sort of equity stake or agreements they might.
Now, when you say outsourcing, you mean like hire a lawyer or like hire a foreign lawyer?
Hire a lawyer. And an additional follow-on question to that question of outsource versus getting an attorney.
Yeah, so I think, obviously I'm a little biased here as a lawyer, but I think when it comes to initial structuring, especially, it's worth kind of taking the time and at least a little bit of expense to make sure that what you're doing is right, because you can fix a lot of things, but especially if it's co-founder relationship stuff and the agreements aren't really in place in a way that makes sense, you can run into major issues down the road. In terms of outsourcing versus hiring a lawyer, there actually is quite a bit of good stuff for kind of the initial setup of corporations. The one I see most is Clerky, and they do a pretty good job. The thing I will say is when it comes to negotiating and things like that, there's really not anything out there that can help you with that, as well as someone with experience doing those kind of deals.
Excellent. Thank you, JD. We have one more here in the room, but I think we have one online as well.
Sure. We have a few comments. One from Greg saying, JD, you rock. Are you a dad yet? Congratulations, ? And he also says Activity 8 is going to put you to work once they get funding.
Thanks, Greg.
And then the question is from Paul. Do you offer for-pay consultations to brand startups?
Absolutely. That's definitely part of our practice. And Craig in particular has a lot of knowledge in terms of like trademark strategy, because that tends to be a big one initially of, how to go forward with that. Is it worth it to get a trademark? What's the strategy around, picking a mark, and how much do you want to, how many marks do you want to get initially versus kind of build a trademark portfolio over a period of time? So totally happy to discuss anything, any consult for your brand or your startup. Absolutely.
For everybody online and in the room, we will be sharing both of our speakers' information as well as this session and their decks on Friday.
Yeah, so the way that you do that, generally speaking, is with a license grant as opposed to a sale of ownership. And you see this, especially in the software world, basically everything that you engage with on the internet, on your computer, is actually a license and not a purchase. And what you can do with a license that's great is you can include a bunch of contractual restrictions. So if you want to say this is for personal use only, not business use, and you'll see that a lot of times with like a freemium model, depending on the company, hey, you can use this for your own personal thing. If you want commercial use, you have to pay for it, stuff like that. So there's lots of ways to kind of, excuse me, to specifically protect kind of the specific asset you're describing, but generally speaking, it's through the use of licenses that you're able to do that.
Yeah, I have a tool. It's covered by intellectual property, but I only want to limit that use by consumers, not for a business. Let's say a business use that tool and then make other stuff from that.
So it's like a physical tool?
Yes.
That's interesting. You could do it. I mean, it's a little odd to think about like licensing a physical tool to someone because they have it in their hand. You can certainly, you have IP protections about that in terms of them like copying it and things like that. Like they can't turn around and start making it again. I think practically speaking, it's going to be difficult to, you know, I would just need to give that some specific thought. That's an interesting question for a physical good and how you can kind of protect the specific use case of that. Because the reality is people are going to have that good and it's going to be a really high monitoring cost.
One more in the room.
And this is kind of simple, JD, but how important are NDAs when you're dealing with customers or potential customers or investors? Are they important, or what's your view on that?
I think they're important for customers, certainly, especially if they're customers that have the capabilities to kind of create what you're doing. Investors tend to not like to sign NDAs. And so that's just kind of the way the world works on that one. From the company's perspective, it's always good to have an NDA in place. There tends to not be a ton of friction in B2B type situations. It's so common that it would be kind of unusual for someone to have a real big pushback on it. Really what it comes down to is, you know, is this counterparty, are they going to take what you're providing them, the confidential information you're providing them, and use it?
Any other questions in the room?
I have one online. Paul's asking, how enforceable are NDAs really though?
They're enforceable to the extent of like what I was just saying. If you're doing business with a potential customer or something like that, who's also maybe a competitor, and all of a sudden, you know, they have your product out in the market, you can point to that NDA and say, hey, we shared this information with you on a confidential basis. You have obligations not to use it, and you did. So in that case, it's extremely enforceable. What can be difficult at times is they can turn around and say, oh no, we made this without reference to your confidential information. But if you don't have an NDA in place, you don't even have a starting point on that. You're just basically sharing with them, and presuming they didn't exactly copy you, you're not going to have any protection whatsoever.
We got another question here.
George, it's an interesting question, especially with, like I said, with the physical good. I would need to give it a little thought. There's definitely probably some copyright angles that you can take to it, but it tends to be that when you there's this concept of like first sale, basically. When you sell a physical good to someone, they typically have the right to do pretty much whatever they want with it.
You talk about Delaware and Nevada C Corp. Which one do you prefer?
I do both. My preference, you know, the lawyer answer, it depends. I think if you're planning to raise money, there's definitely some value to having the Delaware C Corp. The annoying part of it is you're going to incur additional fees depending on where you are. So if you're in Nevada and you have a Delaware C Corp, you have to qualify as a foreign corporation in Nevada as well. So you're kind of layering on additional annual fees that you have to then pay to Delaware and to Nevada. I think that, you know, I don't have a huge preference, but the reality is the market for investors, there's a very strong preference towards Delaware.
I just wanted to clarify or ask you something about, so that whole NDA thing, what if a company actually did have a conversation through Zoom asking about my product, which was at the time patent pending, but it's now has 2 utility patents, and they've already now come out with a very similar product that actually mimics and copies everything that I had shared during the NDA, then how would you go about, like, do I say like to a lawyer or firm, like, hey, these people copied me and like go after them? Is that like, it's like he said, again, she said, right? But I do have the NDA and I have all the information during the conversation that was said that I wrote down in my notes.
Yeah, so so you have an NDA?
They gave me the NDA to sign and I had a lawyer look at it before, yeah, and then I signed it. And then now, like a year and a half later, they came out with this product.
Yeah, so this is in terms of patents, that's really my partner Craig's expertise. But I think the first step is definitely to send a letter, basically saying that they're infringing your patent. There's a bunch of different remedies available, including typically like penalties and things like that for willful breaches, willful infringement, things like that. So it's definitely, I think, worth figuring out kind of an aggressive strategy to try to cut it off.
Is it illegal to, like, I don't want to say snitch, but to snitch them out to their VCs because they raise like millions of dollars based on my technology, or is that illegal? Because I haven't started a lawsuit.
Well, it depends a little bit about what the NDA says, but I think, there's some value in sending kind of a nasty letter, because if they want to raise more money, if they want to do things like that, there's going to be typically reps and warranties that say that there's nothing, there's no pending litigation or anything that would give rise. So by sending a letter like that, they would basically have to disclose that to their VCs. It's hard for me to say, like, in a vacuum right here, what you should do. You should definitely be a little bit careful, but not necessarily timid.
My business is an app, and it's sort of InsurTech and mobility combined. What am I protecting outside of my logos and all that? Because my proof of concept is a company that exists. They're succeeding at what I want to do. And so what do I need to protect outside of my typical name and logo and that sort of stuff?
That's pretty much what you need to protect from the outside. What you need to also make sure is that the company owns everything, that, especially if you have employees or consultants or things like that are helping you build the app, that the company owns the app. So you need to protect you own it individually.
Yes, I'm the owner of the app. I didn't build it, but I'm just saying, my question is, what else do I need to protect you when you speak of intellectual property? Yeah, certainly. So a few things. There's a couple things here. So are you the only owner of the company? Yeah.
So when it comes to the app, right, the first thing that's critical is making sure that the company owns it, or you own it and have the ability to assign it to the company if need be. In terms of the outside stuff, yeah, you're right. You would typically have like some sort of license or end user agreement or terms of use or something for folks that are actually using it. Mm-hmm. And that would include restrictions like they can't make derivative works or copy it or things like that. The open source stuff throws a little bit of a wrench in there, but people can't necessarily just copy exactly what you're doing because, just because you're using open source. Mm-hmm. Tons of people use open source all the time. It's really about kind of that compilation of it that can't necessarily be copied depending on the specific open source licenses. So it sounds like you're doing good. I mean, the main thing is to protect your brand and make sure that, you have protections from your customers with respect to, just the way that they're using your product, your app.
All righty. Thanks, JD. Excellent. Everyone online and in person, thank you so much. Thank you to JD. It was a pleasure to have both of our speakers here today, Alex and JD. Thank you so much for coming out and speaking to our founders and our ecosystem. And we will be sending out their presentation slides and the recordings of these videos again. Let us know if you want to get in touch with them. JD and Alex are here in the community. They're working with startups and founders, so we're happy to put you in touch with them. Next week, please join us again, same time, same places. We're going to be tuning in up north, and we're going to be in person here in Las Vegas at the International Innovation Center. Will be our special session for Global Entrepreneurship Week. We'll have Dan Still talking about Pitch Decks 101 and Faye Almashon talking about go-to-market strategy for startups. Thank you so much. This is AngelNV, and we look forward to seeing you guys next time. Thanks, JD. Thanks, Alex.
Thank you, everyone.